Most traders are familiar with traditional moving average studies, such as the simple moving average or the exponential moving average. And there's nothing wrong with these indicators. But if you want more accuracy and less lag, you can take a look at the double or triple exponential moving average. The double and triple EMAs are an improvement over the traditional exponential moving average because they allocate more weight to recent data points. The reduced lag results in a more responsive moving average, which helps short-term traders to spot price reversals faster. The double EMA was developed in order to reduce the lag of traditional moving average indicators and to provide more timely entries. The double EMA is more responsive to recent price data. Since moving averages tend to be lagging indicators, they can generate somewhat delayed trading signals. The double EMA tries to address this disadvantage present with all moving average studies. Here's a price chart with several moving average studies. The red line represents the 50-period simple moving average line. The blue line represents the 50-period exponential moving average, and the yellow line represents the double EMA line. Notice how the double EMA hugs the price action better than both the simple moving average and the exponential moving average. We can observe that the double EMA is closest to the price points and with the least deviations. Since the double EMA line mimics the prices most closely, it is therefore most sensitive to the market volatility. The double exponential moving average has a somewhat complicated formula behind it. Essentially, the double EMA indicator is a combination of single and double exponential moving averages that results in another exponential moving average. The EMA indicator is named so because it uses an EMA of another EMA and not because it uses two exponential moving averages. You don't need to memorize this formula to implement a double EMA. You just need to know that it will provide earlier entry opportunities since it is more sensitive and more responsive to recent price action. Here are two double EMAs on the same daily chart. The red line is the 50 days EMA, which is significantly detached from the price compared to the 10-day EMA, which is the yellow line. The lower the number of days of the moving average, the higher the effect of the last data point will be. And the lesser the number of days used to calculate the moving average, the higher the volatility of that moving average will be. So, EMA of a lower number of days will be more volatile and will incorporate the price changes more accurately. What's the difference between the double exponential moving average and the triple exponential moving average? Essentially, the triple EMA utilizes a triple smooth exponential moving average along with the single and the double smoothed EMAs. There's no need to know the exact formula of the triple EMA, you just need to understand that this indicator will be even more sensitive to recent price action than the double EMA. Here's a price chart that shows both the EMA and TEMA indicators. The double EMA line is shown in yellow and the triple EMA line is shown in red. It's obvious that the triple EMA reacts to price changes quicker than the double EMA line. For this reason, triple exponential moving average is very well suited for short-term trading due to its more sensitive nature. How to trade using EMA and TEMA indicators. First method, trend analysis. Without knowing what the current market environment is, it will be difficult to consistently beat the market. That's why you need a method for identifying whether the market is trending or not. Although you can often glance at the price chart to get an idea of what the general trend of the market is, you could apply a more objective measure for defining the current trend using double or triple EMAs. The direction of the double or the triple EMA is the direction in which the prices are expected to move in the future. Rising moving averages signifies a probable rising price, whereas falling moving averages signifies a probable price fall. When the price is trading above the double or the triple EMA and the line is sloping upward, then we can say that the trend is up. When the price is trading below the double or the triple EMA line and the line is sloping downward, then we can say that the trend is down. And finally, when the price is trading sideways and the moving average appears relatively flat, then we can say that there is no trend in place or that there is no clear direction currently in the market. Number 2. Dynamic support and resistance analysis. There are two main types of support and resistance levels in the market: fixed and dynamic. Fixed support and resistance represents levels that are static or based on a particular price level. The second class, dynamic support and resistance levels, can change with each new bar that prints on the price chart. The double and triple EMA indicators can be quite useful in finding levels of support within uptrend or levels of resistance within a downtrend. When price moves away from these indicators to the upside and then pulls back towards the EMA line, it often creates an area of support. When prices move away from the EMA indicator to the downside and then pulls back towards the line, that interaction can create an area of resistance. Very important, this movement depends on the proper look-back period for the moving average. If you plan to use the double or the triple EMA indicator for finding dynamic support and resistance areas, the moving averages should have already provided support and resistance in the past. If the indicator didn't provide support or resistance in the past, it probably won't be doing this in the future. Number 3. Entry trigger. The simplest method would be to wait for a price crossover from below to the upside of the double or the triple EMA line to signal a long entry. And you could wait for a price crossover to the downside of the DEMA or the TEMA line to signal a short entry. One of the most commonly used signals produced by moving averages is when a shorter term EMA crosses above or below a longer term moving average. The shorter term moving average crossing above the longer term moving average is considered a bullish signal, whereas a cross below is considered a bearish signal. The choice of lengths of the two moving averages is important when monitoring crossovers. A short to medium term crossover may employ a 10-day and a 50-day moving average, while a longer term system may employ a 50-day and a 200-day moving average. Since moving averages are lagging indicators, keep in mind that a crossover signal may come very late in the new trend, and this lateness is increased as the length of the moving averages increases. Moving average crossovers are best used when a strong continuing trend is present and when confirmed with other elements. Moving average crossovers can also be used as a system of free moving averages. In this case, a bullish signal is triggered when a medium-term moving average is above a long-term moving average, and the short-term moving average crosses above the medium-term moving average. A bearish signal is triggered when the longer-term moving average is above the medium-term moving average, and the short-term moving average crosses below the medium-term moving average. Because moving averages in general lag the price, you can use other tools to filter your signals. One good filter is volume. The idea of this strategy is to take signals that include high trading volumes. As you probably know, the market is trending when volumes are high. During low volumes, prices are likely to range or not trend. This means that low volumes are the major causes for the sideways price action. For this reason, double or triple exponential moving average signals, which appear during lower trading volumes, tend to fail. Using this approach, it's better to enter the market only when prices crosses through the DEMA or TEMA indicators when trading volumes are high. In this example, we added the 50-period triple EMA, and at the bottom of the chart, we added our volume indicator. The chart starts with a range consisting of light volume, Notice that for the crosses beneath and above the triple exponential moving average, we ignored the signals because of the light volume. As volume begins to increase, the price forms a bigger bullish candle, and at the same time, the price begins to move above the triple exponential moving average, and the price continues higher on high volume. Besides volume, I mostly pay attention to the slope of the moving averages. Mainly, the direction of the double or the triple EMA is angled indicates the short-term price direction. When the line is sloping up, that means that the price is moving up. When it's angled down, the price is moving down. There is still a small amount of lag in the indicator, so when prices changes quickly, the indicator may not change its angle immediately. Double and triple exponential moving averages tend to work well in trending markets, but provide little insight when the market is choppy or range-bound. During such times, the price will frequently cross back and forth across the lines. Also, the reduced lag of the double and triple EMA can be good in some scenarios, like when the actual price reversal occurs, because it gets you out of the trade quicker. Yet, reduced lag can also result in overtrading. Double and triple exponential moving averages provide more signals than a traditional moving average. For example, if you don't choose the correct length for the moving average, the indicator can tell you to close your position when the market makes only a minor move against you. You close your position only to watch the price continuing in its original direction. Sometimes lag is good, and sometimes it isn't. It depends on what you want from the indicator. That's why choosing the correct length is very important. It's up to you to find the balance and determine exactly how much lag works for you. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel, and click the bell icon to stay notified every time we upload a new video. Until next time.